Munich, capital of Bavaria, home to the world's best beer and football, is Germany's most prosperous city. Nobody watching the onslaught of shoppers or the overcrowded beer gardens around the Marienplatz would suspect a looming economic crisis. However, while Ukraine and Syria have wiped much economic news from the front pages, Europe's financial problems have been on the minds of German investors for months. Reason enough for a large Munich-based finance group to call on Jerome Booth, chairman of New Sparta, to share his views on global fiscal policies and investment strategies. As expected, the guest speaker did not pull any punches.
So we live in a world of denial. One of the most interesting things that that sort of fascinates me is how people have different world models. They have different perceptions of reality. And the really interesting thing is when these perceptions suddenly change. So I'm reminded here of Thomas Kuhn, who wrote this famous book, The Structure of Scientific Revolutions. And it's from that book we get the term paradigm shift. First of all, he's saying that scientists do not work things out from first principles. I mean, if they did, you know, they'd never get very far because they'd be redoing the same work. So you have to, what you have is a consensus of models, of theory. So what happens is you get a, if you like, a paradigm. And the interesting thing is when you shift from something like Newton to Einstein. So Einstein comes along and he's got a new theory, and it explains everything that Newton explains, plus it explains the trajectory, the orbit of Mercury, which Newton doesn't because the gravitational pull actually is so big it distorts space-time to a measurable extent. So what's interesting is that even then, it takes a while for the scientists to change their prejudice. And then, of course, there's this sort of S-shape move, but then you have to wait for all the scientists to die before you actually get 100% consensus. Now, that's science. That's kind of evidence-based stuff, or we hope it is. A lot of stuff that they call science isn't evidence-based, but let's assume it is. And what we do in investment, of course, is a long way from that.
Unafraid to question well-established finance gospels and economic dogmas, Jerome Booth sees the source of many evils emanating from one fatal shortcut.
If you go back to 1959, Markowitz wrote a book, what do you call a memorandum, 360 pages, I call that a book. And he says in one point, you know, he's trying to explain the variance of a particular asset. And he's explaining it in terms, you can explain the variance, he calls it risk, he's talking about volatility. In terms of the idiosyncratic risk, as he calls it, which is only specific to that stock, and covariances with other stocks, and correlations to an index. And there's one sentence here, it says, but for computational ease, we shall ignore the covariances to other stocks. That's it. That germ, not theoretically based at all, no justification whatsoever, is why today, decades on, we have this lunacy, in my view, of using indices to represent asset classes as building blocks in asset allocation.
Derived from theoretical misconceptions and an inappropriate use of finance theory, Western policymakers and market players developed flawed investment strategies, which led to massive distortions in asset allocation, affecting hundreds of millions of people.
There is still a huge distance to go to really start thinking about how you have a model of building blocks which in some way represent the overall investable universe. But of course, if you're invested, if you look at the indices, they only measure what we call investable. Actually, that doesn't mean, we don't mean investable, we mean easy to invest in, which is a different thing. The other problem is that we have some of the debates between asset allocation manager selection, I think are driven from some of the problems in theory. We have problems with passive and active and things like that. Passive investing, I mean, all I have to do there is really remind you of what happened in '01 in Argentina. It was so obvious. And the only people really who didn't, who lost money were the index trackers. The idea that somehow an asset class or an index is safe, and you can't get safer than that, you can't reduce volatility further than that, is actually wrong. You were taught at business school that, you know, as you add assets to a portfolio randomly, then after about 15 assets, you can't get any more diversification. That's what's taught in business school. It's not wrong, but the key word is random. If you don't add them randomly, and you've got some intelligence, and you add, say, the low volatility or the low risks ones, then of course you can. No problem. Very easy exercise.
One of the key points Dr. Booth made in his speech in front of fund managers in Munich referred to the conflation of risk and uncertainty by Western finance institutions.
Risk is defined as where you have random events and you know the probability distribution, so you can hedge or insure it, as opposed to uncertainty where you don't know the probability distribution and therefore you can't. And actually Frank Knight called them one-off events. Keynes' general theory, in a single sentence, apologies to Keynes, is that when you have a lot of uncertainty in an economy, then entrepreneurs will not build new factories and employ more people, and they will delay those decisions. And as a result, that creates more uncertainty for others in the economy, which has a positive feedback effect, which causes a slump.
Because risk is measurable and uncertainty is not, investors are misguided by a narrow view of risk in their decision-making process. One consequence of this, according to Dr. Booth, is the tendency to overlook opportunities offered in emerging markets.
This is the idea that what happens in the core, Western Europe, United States, Japan to a certain extent, affects the periphery, the emerging markets, but we can completely ignore the effects of the periphery on the core. That's core periphery disease. So, maybe that didn't really matter in some periods in the past. It matters now. An example is getting worried that the Fed rate increase is somehow going to cause this massive outpouring, from emerging markets. Because, of course, we have this linear view of risk. So if the US is risky, the emerging markets must, by definition, be riskier. Right? And if the US Fed changes interest rates, of course that's going to affect every central bank in the world. I mean, forget about the evidence that this is not true. Don't worry about that. Because actually on a day, the next day, that probably is true. But for more than a few days, it isn't. It really isn't. So we have, but we assume that the US, Europe has a huge impact on everybody, but we ignore the impact the other way around. So there were reports. I remember one IMF report shortly after 2008, and it asked the question, and you're still getting the same reports, different numbers, but they asked the question, how much money might leave the emerging markets if there was another problem in Europe or the United States? And the answer came back, $15 billion. Okay. Core periphery disease is not asking the question the other way around. It's not asking the question, how much money might leave Europe and the United States if there's another problem in Europe and the United States? In other words, how much emerging market capital might be withdrawn? Remembering that they already have $12 trillion of just so-called liquid US and European sovereign bonds in their portfolio, and another 4 or 5 in sovereign wealth funds, right? We're talking 2 orders of magnitude more money might go the other way. Oh, but that'll never happen. But it did happen in 1971.
Dr. Booth saved the best for last when he told the group of investors that he expects the US bond market to crash. And when?
The US economy, is still very inventory driven. You've still got these 46 million people on food stamps, etc. And I believe you only get really sustained growth back when the consumer comes back. And for the consumer to come back, for it to be proper consumer-led growth, you need to get the household debt to income down to where it was pre-bubble, which was 90%. And at the current trajectory, that's at the end of next year. When that happens, the problem is that real growth, which actually convinces bond market investors that they need to get paid for future inflation, which is clearly not the case at the minute, means that you get a steepening of the yield curve. And you may think, well, that's not so bad in itself. But if you then combine that with the additional fiscal costs of debt service, it could create a pretty radical and quite sudden bond crash, which could then obviously have contagion effects, and then you've got the whole thing going off.
Quite some food for thought. Whether the crash will come or not, Dr. Booth appealed to his audience to exercise more vigilance and, in particular, to pay more attention to fundamentals in all asset allocation decisions.